Jamie, just from the buy side perspective, really curious about how the pandemic and the expected massive budget deficits is changing the way that you're thinking about credit selection as you look across what has now become sort of a vastly different environment.
Great to speak to you, Taylor. I think you have to completely rethink how you approach the market right now. Quality is the thing that is absolutely going to win out. So focusing on the highest quality bonds, because look, in an economy like this, no bond, no credit across fixed income is going to be immune from credit pressure. So what we're doing at Neuberger Berman is going back and looking at our existing investments and also thinking about new ones and saying, how do we re-underwrite them for this new environment? So I think quality is the way to go right now. And what's interesting, if you look at 10-year high-quality munis, they're yielding almost 170% of treasuries pre-tax. I think when you see yields like that, despite potential volatility, that's going to be an appealing proposition for a lot of investors.
And are you able to get the yields that you just mentioned that, frankly, we haven't been able to see these in years in the muni market in the highest quality, like you mentioned, a AAA, a AA, or are you going down a little bit to the highest or the lowest quality, I should say, still, though, within the investment grade spectrum?
Yeah, I think, look, the whole market has repriced, and to your point, Taylor, the lower quality investment grade bonds spreads have moved out a lot. I think you have to be cautious there. You have to have the right type of investor or vehicle to play in that part of the market. But I think for most individuals, if you just there are a lot of unknowns right now. If you just play the quality parts of the market, you can find those yields and those ratios that I just described. It may take a little longer to get invested, but I think we're in a world right now where cash is king, and if you just really, really play it cautiously, I think investors can have a really good outcome in this market.
Within the corporate bond market, Jamie, fallen angels has become a real risk. You see some of the triple Bs be downgraded into the junk territory. Is that to a risk that you see in the muni market?
Yeah, if you look at the triple B part of the market, obviously Illinois is the big name in there, and then there's a lot of healthcare credits. Certainly a possibility that you could see some names in that category move down. I think the good news about muni credit quality is it tends to move in a bit more of an incremental manner, and so it gives investors time to assess and decide if they want to keep holding bonds. Illinois is an interesting one. They're in the market today. Again, not for everybody, but when you're talking about yields that are pushing up close to 6%, that is a lot of compensation for a state-level credit. So it really comes down to investors' overall risk tolerance and whether they think they're, getting paid appropriately for a ride on some of those names, which may be a bit more bumpy.
Jamie, finally, just about 30 seconds here. How is retail sentiment? You've seen inflows now come back to the market. Is that a healthy sign?
I think it's a very healthy sign. We have a thesis here that when things calm down, there is going to be a global search for high-quality yield. Munis are a great asset class to fit that bill. And I think for investors that want to hunker down a little bit, play it safe with a big part of their asset allocation, munis really, really work well, and that's why you're seeing retail sentiment improve so much.